There is a number that keeps coming up in every serious financial conversation happening right now on Wall Street, and that number is $8 trillion. Goldman Sachs estimates that the present discounted value of the capital revenue resulting from generative AI for the U.S. economy has a baseline estimate of $8 trillion. $8 trillion. That's not a rounding error. That's not a bold prediction from some crypto influencer on the internet. That comes straight from one of the most powerful investment banks that has ever existed. And yet, here's what's strange. Even with that kind of promise sitting on the table, some of the sharpest minds in finance are not celebrating. They're worried. Quietly, carefully, deliberately worried. And when Wall Street gets quiet about something, that's usually the moment the rest of us need to start paying very close attention. My name is Kunal, and this is Failed Finance, where we don't dress up uncomfortable financial realities to make them easier to swallow. We look at them straight in the face. So let's do exactly that. Because what is happening in the markets right now has a specific shape to it, a pattern. And that pattern has shown up before in American financial history. Not once, multiple times. And every single time it showed up, the people who ignored it paid a very steep price. So before we talk about what you should do, let's talk about what is actually happening. Because if you don't understand the setup, the strategy means nothing. Here's where we are. The S&P 500 index jumped 16% in 2025, with AI winners NVIDIA, Alphabet, Broadcom, and Microsoft contributing the most. The broader market has been on a tear. New highs, record closes, headlines screaming bull market. But here's what those same headlines aren't screaming. The tech sector itself, the very sector that's supposed to be driving all this growth, is sitting roughly 10% below its recent peak even as the rest of the index pushes higher. That divergence. That split between where the headline index is going and where tech is actually trading. That is not a coincidence. That is a signal. And when you understand what that signal has historically meant, it changes how you see everything else. As divergence grows across multiple dimensions, so do the risks of something going badly wrong, as JP Morgan Asset Management's chief global strategist recently put it. He's not an alarmist. He's one of the most measured voices in institutional finance, and he used the word wrong. That matters. Now, let's back up and build this thing properly, because the $8 trillion figure, and everything around it, deserves to be understood in full context, not just as a headline. The AI bubble is a theorized stock market bubble growing since 2025 amid the AI boom, a period of rapid increase in investment in artificial intelligence that is affecting the broader economy, with speculation largely originating from concerns that leading AI tech firms are involved in a circular flow of investments that are artificially inflating the value of their stocks. Now, I want to be very clear here. I'm not saying AI is fake. I'm not saying the technology doesn't work. The technology is extraordinary. What I am saying is that the money flowing around this technology and the valuations being assigned to companies involved with this technology have taken on a life of their own that may be running dangerously ahead of reality. The AI boom may turn out to be the greatest capital investment bubble of all time. Amazon, Alphabet, Meta, and Microsoft alone spent nearly $300 billion on capital expenditures in 2025. Let that land for a second. $300 billion from 4 companies in a single year. That's more than the GDP of most countries on the planet. And that spending is still accelerating. AI investment accounts for an increasingly large proportion of U.S. economic activity. The collective capital expenditures of the hyperscalers are estimated to be 1.3% of U.S. GDP, the vast majority of which is going into AI hardware and infrastructure. And for 2026, it is projected to rise to 1.6% of U.S. GDP. So these companies are not just investing in AI, they are betting their entire futures on it. And right now, the cash flow needed to justify those bets has not materialized. Yet so far, the cash flow that's needed to pay for this investment hasn't appeared. OpenAI is projected to have $12 billion of revenue and an $8 billion operating loss for 2025. According to its own forecasts, the The company expects annual losses to double again to $17 billion in 2026, then again to $35 billion in 2027. Meanwhile, AI still does not have a clear path to profitability. This is where it starts getting really uncomfortable. You have a company, OpenAI, that is arguably the face of the entire AI revolution, valued at $750 billion, and it is losing money at a pace that is doubling year after year. Not slowing down, doubling. So someone out there sitting on an OpenAI investment is betting that profitability arrives before the losses become existential. That's a very specific bet. And it's the same kind of bet that was being made in 1999, just with different company names on the front door. Now here is where I want to bring in something that always grounds me when markets get frothy. Warren Buffett, the man who has navigated more market cycles than almost anyone alive, has spent decades building Berkshire Hathaway by refusing to chase trends. Warren Buffett has never been one to push Berkshire Hathaway into hot trends. In his 1996 letter to shareholders, he wrote that he is searching for operations virtually certain to possess enormous competitive strength 10 or 20 years from now, and that a fast-changing industry environment may offer the chance for huge wins, but it precludes the certainty he seeks. And yet here's the fascinating part. Even Buffett, the man who once called tech stocks speculative and avoided them for decades, now finds himself with roughly 23% of Berkshire's portfolio tied to AI-connected companies. In 2017, Buffett told CNBC that he regretted not buying shares of Google's parent company, Alphabet, earlier. And he recently remedied that mistake, loading up on the stock in the third quarter of 2025. There's a lesson buried in that admission. Even the greatest value investor of all time missed the Google trade for years and acknowledged it. But notice what he bought. He bought Alphabet, a company with massive, proven cash flows, real revenue, dominant market position, not a startup burning through capital. The distinction matters enormously right now, because not everything labeled AI is the same animal. And that's exactly where this story gets complicated. The Shiller cyclically adjusted price-to-earnings ratio exceeded 40 in 2025, a level reached only once before in history, immediately preceding the dot-com crash. However, unlike the internet bubble, today's AI leaders generate substantial profits, with NVIDIA delivering $99 billion in trailing 12-month profit at 53% net margins. So we have a CAPE ratio that only hit this level right before the dot-com implosion. But we also have companies that are genuinely, massively profitable. Both of those things are true simultaneously, and that's what makes this moment so genuinely difficult to navigate. It's not 2000. But it rhymes loudly enough that ignoring the comparison is foolish. Let me show you exactly what I mean. Between 1995 and its peak in March 2000, investments in the NASDAQ Composite Stock Market Index rose by 600%, only to fall 78% from its peak by October 2002, giving up all its gains during the bubble. 600% rise, then a 78% collapse. Gone. Not a dip. Not a correction, an annihilation. And who got annihilated? During the dot-com crash, many online shopping companies like Pets.com, Webvan, and Boo.com, as well as several communication companies such as WorldCom, Northpoint Communications, and Global Crossing failed and shut down. These weren't obscure companies. Pets.com had Super Bowl commercials. WorldCom was one of the biggest telecom players on the planet. They were household names backed by Wall Street's biggest names, and they went to zero. But here's the other side of that story, the side that actually gives us a roadmap for today. A rare few, like Amazon, Google, and eBay, weathered the storm. Shares are now worth upwards of 3,000% more than they were in their dot-com bubble days. 3,000%. The people who held Amazon through the dot-com crash, where the stock fell roughly 90% from peak, are now extraordinarily wealthy. Amazon lost 90% of its stock value during the crash. It took a decade to recover. Today, Amazon is one of the most valuable companies in the world. A decade. Think about that. If you bought Amazon in 1999 and held on through that 90% decline, you would have had to endure a decade of pain before vindication arrived. Most people couldn't do that emotionally or financially, which raises the real question that every American investor needs to be asking right now. Not, is AI real? But which AI companies are the Amazons of this era, and which ones are the pets.coms? Because both will exist. Both already do exist. The difference between them will be whether the underlying business can eventually generate cash flows that justify the valuation. And right now, for a lot of companies in the AI space, that answer is dangerously unclear. The key risk is the disconnect between $400 billion in infrastructure spending and only $100 billion in enterprise AI revenue. $400 billion going in, $100 billion coming out. That math has to change, and change dramatically, or someone is going to be holding a very expensive bag. Now here's something that most people aren't talking about, but that Goldman Sachs laid out in remarkable detail. The market's enthusiasm appears to have sprinted far beyond the baseline macro calculations. Since the introduction of ChatGPT in November 2022, Goldman calculates the value of companies directly involved in or adjacent to the AI boom has risen by over $19 trillion. $19 trillion of market value has been added since ChatGPT arrived. Goldman's own baseline estimate for what AI will actually generate for the U.S. economy is $8 trillion. So the market has already priced in more than twice the baseline economic value. The plausible range for these future capital revenues sits between $5 trillion and $19 trillion. 5 to 19. The market is currently priced at the top end of that range, or above it. Which means if AI adoption comes in at the low or even middle end of that projection range, a lot of these current valuations simply cannot be sustained. Drop a comment below and tell me, are you personally invested in any AI-related stocks right now? I'm genuinely curious how many of you in the failed finance community have direct exposure to this, and whether you're sleeping well at night holding those positions. Because there's something else happening that makes this even more structurally concerning. And it has to do with how concentrated this market has become. Market concentration has reached unprecedented levels, with the top 10 stocks now representing 35% of the S&P 500, compared to 25% at the peak of the dot-com bubble. This is a number that should genuinely stop you in your tracks. During the most extreme speculative mania in modern American financial history, the dot-com bubble, the top 10 stocks accounted for 25% of the S&P 500. Today, that number is 35%. We are more concentrated now than we were at the peak of the dot-com madness. Market concentration has reached levels not seen since 1970, with just 5 companies accounting for 30% of the S&P 500's total weight. And retail inflows into technology funds have exceeded $700 billion since January 2025. A pace 5 times faster than during the dot-com bubble's peak, 5 times faster than the dot-com peak. Let that settle. Retail investors, everyday Americans with 401(k)s and brokerage accounts, are piling into technology funds at a rate that dwarfs the frenzy of 1999. And the people running the smartest money in the world are starting to say, very quietly but very clearly, that this trajectory is unsustainable. Deutsche Bank's global economics team released a world outlook describing 2026 as anything but dull and framing the year as 1999 meets 1990, but hopefully not 1973. AI-driven optimism colliding with a Middle East energy shock. 1999 meets 1990 meets 1973. That's 3 of the most financially brutal periods in American history colliding simultaneously, according to one of the world's most sophisticated banking institutions. And they're calling it hopefully not 1973, the year of the oil crisis that sparked stagflation and obliterated stock returns for a decade. Now, here's where I need to be straight with you, because at Failed Finance, that's what we do. Not everything I've laid out so far means a crash is imminent. The bull case is real, and it deserves to be heard. Morgan Stanley analysts described bubble fears as misplaced or premature, pointing to data showing that the median cash flow and capital reserves of the top 500 U.S. firms were about 3 times higher than during past bubble periods, and noted that today's market leaders, unlike dot-com era companies, generate substantial revenue and positive margins. This is a legitimate counterargument. These are not the profitless dot-com startups of 1999. NVIDIA trades at 24 to 26 times expected earnings versus Cisco's 472 times earnings at the 2000 peak. The Magnificent Seven trade at roughly 28 times expected earnings, about half the tech sector's valuation during the dot-com era. Half. So on a pure valuation basis, today's AI leaders are nowhere near as overextended as Cisco and company were at the height of the dot-com fever. That matters. Federal Reserve Chair Jerome Powell also drew a distinction from the dot-com era, arguing that AI companies generate real revenue and that spending on AI data centers is contributing to broader economic growth. When the Fed chair himself is drawing that line, it's not something to dismiss. But here's where I push back. Gently, carefully, but firmly. The fact that today's valuations are less extreme than 2000 doesn't mean they're sustainable. It means they're less extreme. There's a big gap between not as crazy as the craziest moment in market history and perfectly rational. And that gap is exactly where risk lies. The hyperscalers are trapped in a prisoner's dilemma. If they hold back from the AI arms race, there's a danger that one of their competitors will emerge triumphant. This situation more or less guarantees that they collectively overinvest. Collective overinvestment by the biggest companies on Earth. Not because they're foolish, because the game theory demands it. Nobody wants to be the one that blinked. Nobody wants to be the Kodak of AI. So they all spend, and they all spend more than they probably should, and the chips and data centers and infrastructure pile up while the revenue to justify all of it lags behind. A National Bureau of Economic Research study published in February 2026 found that despite 90% of firms reporting no impact of AI on workplace and productivity, executives projected AI to increase productivity by 1.4% and increase output by 0.8%. 90% of firms not seeing an impact. Yet executives are projecting productivity gains and markets are pricing in transformational returns. That gap between what is happening on the ground at actual businesses across America and what Wall Street is projecting, that is precisely the kind of disconnect that precedes a painful repricing. And it's not just a domestic concern. In January 2025, the Chinese-made chatbot DeepSeek demonstrated performance on par with AI models developed at far greater expense. The stock prices of many AI companies dropped. For example, NVIDIA's dropped 17%, or approximately $600 billion in market value in a single day. $600 billion evaporated in a single day. Because a Chinese startup proved that you might not need to spend hundreds of billions to build a competitive AI model. That DeepSeek moment was a preview, a stress test of what happens to these valuations when the assumptions underlying them get challenged. And the market shrugged it off within weeks, which might be the right response. Or it might be Wile-E, coyote running off the edge of the cliff, still moving forward, legs still spinning, not yet looking down. So where does that leave you, the American investor, trying to navigate all of this in 2026? Here's what I think you need to internalize before we get into strategy. The lesson of every single bubble in history is not sell everything before the crash. Some survivors like Amazon and NVIDIA became giants, while others like Pets.com and WorldCom were wiped out completely because the technology was real. The problem was timing and excess exuberance. The technology is always real. The internet was real. AI is real. But real technology and rational valuations are two entirely different conversations. Goldman Sachs economists predict that generative AI will automate 25% of all work tasks, resulting in a 15% cumulative gross upside to U.S. labor productivity. That's an enormous number, and if it's even half right, the economic transformation will be legitimate and lasting. But here's the question. Which companies capture that value? Not all of them. History is very clear on that. The underlying technologies proved revolutionary, with survivors like Amazon, eBay, and Cisco becoming foundational infrastructure companies. But the difference was timing and patience. Companies that survived did so by eventually achieving profitability and demonstrating real economic value, not through speculation about future dominance. Profitability, cash flow, real economic value, not a vision board, not a roadmap to revenue that starts generating in 2027 or 2028. Real money, hitting the books, now or very soon. That's what separated the Amazons from the pets.coms. And that same filter, applied ruthlessly and without sentiment, is what will separate the winners from the casualties in the AI era. Now, I've given you the full picture of the landscape, the $8 trillion opportunity, the $19 trillion in market value already added, the CAPE ratio at levels seen only before the dot-com crash, the 90% of firms not yet feeling AI productivity gains, the hyperscaler prisoner's dilemma driving collective overinvestment, the DeepSeek shock that erased $600 billion in a single day, the dot-com comparison with both its warnings and its crucial distinctions. You have the full map, in part. 2, we're going to talk about what you actually do with all of this, because knowing the risks is only half the job. The other half is positioning yourself so that no matter how this plays out, crash, melt up, or slow grind, you come out on the right side. And I promise you, the strategies we're going to cover are not sell everything and go to cash. They're smarter than that, more nuanced, more aligned with where the real risk-adjusted opportunity actually sits in this market. Don't go anywhere. Here is what almost nobody on financial media is willing to say out loud: surviving a bubble, and even profiting from it, is not about predicting the exact top. It never has been. The people who tried to call the exact peak of the dot-com bubble in 1999 were either 6 months too early or 6 months too late, and most of them got hurt worse than the people who simply diversified intelligently and held quality. While it's difficult to draw any conclusions from the data, hearten it of. Bank of America warns investors against fleeing the stock market even if they believe it's in a bubble, because the last stretch of the rally is typically the steepest, and missing out would be costly. The last stretch is the steepest. Think about what that means in practical terms. If you pulled out of tech stocks in 1998 because the valuations looked insane, and they did look insane, you would have missed the most explosive year of gains in NASDAQ history, the 1999 run, the final blow-off, top. And then you would have felt vindicated in 2000 when the crash came, but you would have left enormous money on the table waiting for the crash that took longer to arrive than anyone expected. So strategy number 1, and I want you to hear this clearly, is not about timing the market. It's about building a portfolio that doesn't require you to be right about timing. That means diversification, but not the lazy kind. Not just buy a bunch of different stocks. I mean structural, intentional, category-level diversification that acknowledges the specific risk profile of this particular market moment. One way to hedge is to buy cheap value plays like UK stocks and energy companies, according to Bank of America's Michael Hartnett, one of Wall Street's most watched strategists. Now, I'm not saying go load up on British petroleum stocks tomorrow, but the underlying logic is correct and worth understanding. When a bubble exists in one area of the market, the assets that have been neglected, the boring, uncool, under-owned assets, tend to offer genuine value precisely because everyone's attention and capital is pointed elsewhere. Right now, attention and capital are pointed at AI, which means there are pockets of the American market, sectors that are genuinely undervalued, genuinely cash-generating, genuinely resilient, that are being ignored. Energy infrastructure, dividend-paying industrials, healthcare with real earnings, consumer staples with pricing power. These aren't glamorous. They don't have keynote addresses at tech conferences. But they also don't require you to believe that AI revenue is going to 10x in the next 3 years to justify their current prices. And that distinction is incredibly important in a market where the difference between a company being priced for perfection and a company being priced for reality could ultimately be the difference between your portfolio holding up or getting cut in half. Let me give you a concrete way to. Think about this using something from the dot-com era that most people don't realize. From the March 2000 peak to the 2002 trough, the Dow Jones Industrial Average declined approximately 37%, significantly less severe than the technology-heavy indices. This differential performance occurred because the DJIA contained a lower concentration of the most speculative technology and internet stocks, instead holding more established industrial, financial, and healthcare companies, 37% versus 78%. That's the difference between pain and destruction. The diversified investor in 2000 who held industrials and financials and healthcare alongside their tech positions got hurt, but they recovered. The person who was all in on the NASDAQ got wiped out, and in many cases never came back to the market at all. That psychological exit, the permanent abandonment of investing, is actually the biggest long-term wealth killer, not the crash itself. Which brings me to dollar cost averaging. And I want to make this feel real rather than textbook. Most Americans who are building wealth are doing it through some version of regular contributions. A 401k where money comes out of every paycheck, a brokerage account where they invest monthly. That structure is not just a convenience. In a volatile market, it is a genuine risk management tool. When prices drop, your fixed dollar amount buys more shares. When prices rise, it buys fewer. Over time, your average cost per share smooths out in a way that lump sum investing never can. Here's the thing about dollar cost averaging in a potential bubble environment specifically. It protects you in the scenario where things go sideways without requiring you to abandon your positions if things keep going up. You're not making a bet. You're building a position systematically, over time, regardless of what the headlines say. And that approach, boring as it sounds, has historically produced better risk-adjusted outcomes than almost any market timing strategy ever devised. With commission-free trading available on smartphone apps, plentiful cheap margin loans, and an array of leveraged ETFs, it has never been easier to speculate. And because it's never been easier to speculate, it's also never been easier to blow yourself up financially. The same apps that make it frictionless to invest $100 a week into an index fund also make it frictionless to buy 3 times leveraged AI ETFs at 11 p.m. on a Tuesday. One of those things builds wealth. The other one is how people end up having to delay retirement. Now let me talk about something that the mainstream financial conversation largely skips over when discussing the AI bubble. And that's the question of what the second and third order effects of a significant AI correction would look like for regular American households. Because this isn't abstract. AI-related CapEx now contributes 1.1% of U.S. GDP growth, amplifying downside risk. To financials and consumer discretionary as well if AI enthusiasm wanes. 1.1% of GDP growth is coming from AI capital expenditure. That means construction jobs building data centers, manufacturing jobs producing chips and cooling systems, logistics jobs moving equipment, real estate markets in the areas where hyperscalers are building. If that spending slows, if the hyperscalers hit a wall on their CapEx and pull back, the ripple effects hit sectors of the American economy that have nothing to do with AI. The ironworker in Virginia building a data center. The commercial real estate market in Northern Virginia, which has one of the densest concentrations of data center construction in the world. The power utilities that are signing long-term contracts to supply electricity to these facilities. All of them have exposure to the AI spending cycle in ways that aren't obvious when you're looking at a ticker symbol. This is why understanding the macro picture, the way it connects from Wall Street to Main Street, is so critical. And this is why the big economic issues of 2026 are all interconnected in ways that aren't being discussed holistically enough. Interest rate policy, the national debt. The $38 trillion national debt is to blame for over $1 trillion in annual interest payments, according to the Committee for a Responsible Federal Budget. Tariffs creating supply chain uncertainty. The labor market that's neither hiring aggressively nor firing aggressively. A kind of suspended animation where neither growth nor recession feels fully real. All of these factors form the backdrop against which the AI bubble question has to be evaluated, because even if AI delivers on every promise, even if Goldman's $8 trillion baseline turns into the $19 trillion high end, you still have to navigate getting from here to there through a macro environment that has genuine landmines in it. What moves do you make right now, given all of this? Let me be as practical as I can. First, If you have significant concentration in any single AI name or sector, the time to think about rebalancing is before a correction, not during one. When the top 10 stocks represent over 1/3 of the entire S&P 500, a correction in these names would have outsized implications for the broader market. That means a correction in the biggest AI names doesn't just hurt tech investors. It hits the broad index funds that virtually every American with a retirement account owns. Your 401k has more AI concentration than you probably realize. Check it. Second, the question of which AI companies to hold versus which ones to avoid comes back to the cash flow question every single time. During the dot-com era, many technology companies had minimal revenue and no clear path to profitability. In contrast, today's AI leaders boast robust cash generation and measurable revenue growth. Use that as your filter. If an AI company cannot show you a credible path to positive cash flow in a reasonable time frame, the valuation it carries is built entirely on hope. And hope, as any seasoned investor will tell you, is not a risk management strategy. Third, and this is the one that most people resist emotionally, consider the parts of the market that everyone is currently ignoring. Meta, Alphabet, and Oracle will need to raise $86 billion combined in 2026 alone, according to Société Générale estimates. That debt issuance creates pressure. It creates interest, rate sensitivity. It means these companies need the macro environment to cooperate even while they're executing on their AI visions. There are other companies, unglamorous, uncelebrated, that carry far less debt, generate steady free cash flow, and are trading at multiples that make sense even in a slow-growth environment. Those companies don't make for exciting YouTube thumbnails, but they make for very solid portfolio foundations. What's your take on all of this? Drop it in the comments. I genuinely want to know how you're positioning yourself in 2026. Are you leaning into AI names? Are you rotating toward value? Have you started dollar cost averaging into a more diversified position? Your perspective matters, and this community genuinely learns from each other. Now, here is the final thing I want to leave you with, because I think it's the most important insight of everything we've covered today. The technology was real. The problem was timing and excess exuberance. Profits matter more than hype. The internet was real. The internet changed everything. It changed how we shop, how we communicate, how we consume news and entertainment. All of that is true. But the people who invested in the internet at the peak of the dot-com bubble and picked the wrong companies still lost everything, even though the underlying technology proved to be revolutionary. The technology being revolutionary did not protect them. What protected the people who came out ahead was owning. Companies with real earnings power, diversifying across asset classes, not using leverage they couldn't afford, and having the emotional discipline to hold through volatility instead of panic selling at the bottom. Buffett assessed the valuation of Apple stock and deemed it to be well above its intrinsic value. And that assessment led him to reduce Berkshire's Apple position by over 70%, even though Apple remains his largest holding. The man who called Apple probably the best business I know in. The world still trimmed it aggressively when he felt the valuation exceeded intrinsic value. That's not pessimism. That's discipline. And discipline, applied consistently, without emotional interference from market euphoria or market panic, is the actual moat that separates people who build generational wealth from people who ride bubbles up and then ride them back down to zero. As happened with the internet, a path to profitability will likely emerge in time as AI spreads through the economy. But for now, total revenue for AI is estimated at less than $50 billion against $1 trillion or more of investment. Less than $50 billion coming in against $1 trillion going out. The math has to close eventually. The question is which companies are still standing when it does, and whether your portfolio is positioned to own those companies. If you found this valuable, share it with someone who needs to hear it. And if you haven't already, subscribing to Failed Finance costs you nothing and ensures you don't miss the next time we sit down and work through something this important. The $8 trillion question is real. The risk is real. But so is the opportunity. If you approach it with clear eyes, a steady hand, and a strategy built on reality rather than hype, That's exactly what will keep helping you build, right here.